Okay, let's unpack this. We're just coming off a week where honestly the headlines felt like they were pulling in opposite directions. You had global markets cheering, hitting these major milestones, the Dow, the S&P 500, setting fresh records. But then at the same time, you've got policy decisions both here in the US and overseas injecting, well, a heavy dose of uncertainty right into your budget and into the political sphere too.
It really is a perfect storm, isn't it?
Yeah.
Shows how fast investor sentiment can pivot, especially on monetary policy news. Sometimes it seems to just override those bigger geopolitical worries, well, at least for a little while. So our mission today really is to sift through a whole stack of sources and make sense of this split picture. We're zeroing in on three big themes. First, the global fallout from central bank moves, and, interestingly, some dissent from within. Second, the high-stakes tech scene thinks soaring AI values, kind of mixed IPOs, and how tariffs are hitting prices right now. And third, maybe most importantly for day-to-day life, what all this churning means for your wallet and whether you can trust the marketplaces you use.
Right. And let's start with the good news, the optimism. That really kicked off at the Federal Reserve, didn't it? They cut their main lending rate, the benchmark overnight rate, by a quarter point. First cut since back in December.
Yep, and the reaction. Pretty much instant. It wasn't just the big guys like the Dow and S&P 500 rallying, though they did. The really interesting signal, I think, came from the small cap market, the Russell 2000. It finally broke out of this incredibly long drought without a closing high. What was it, 967 trading days? Just wow.
That is a long time. Why is the Russell 2000 hitting a high, like, more significant than the Dow reaching one again? What does that tell us?
It's about risk appetite, really. When it's just the giant tech stocks pulling the S&P 500 up, that suggests confidence is pretty narrow, focused. But when Russell 2000 joins the party, and remember, that's tracking smaller, often more U.S.-focused companies, it means that investors are getting bolder. They're willing to put money into potentially higher growth, but maybe riskier, smaller companies. They think the broader economy can actually support them.
Okay, so broader confidence. And this wasn't just a U.S. story, right? The optimism spread.
Absolutely. We saw European stocks finish higher. And UBS, for instance, put out a note predicting this cut will keep boosting stocks, especially in areas like AI and general consumption.
And it has specific regional impacts too.
Oh yeah, it goes deeper. The Fed's move is expected to be a pretty big help for banks in the Gulf Cooperation Council, the GCC countries. Think Saudi Arabia particularly. Why? Because their currencies are often pegged to the US dollar. So when the Fed eases rates, it takes pressure off their own monetary policy. And that's crucial for them right now, given the huge amounts of money they need for all those mega projects they're funding.
Interesting connection. But, okay, while the Fed was cutting, the global picture wasn't uniform easing. The Bank of Japan, Bank of England, they held back.
Exactly right. Cautious is the word. The BOJ kept its rate steady at 0.5%. Matched forecasts, really. They pointed to core inflation slowing down. It hit 2.7%, the low since November 2024. And the Bank of England did the same, holding its key rate at 4%. It suggests that, while the U.S. might see a clearer path to easing up, other major economies are still thinking, hold on, let's make sure inflation is really tamed before we cut.
And speaking of caution, or maybe lack of it, depending on your view, the vote inside the Fed itself wasn't unanimous this time.
No, it wasn't. We saw a really notable dissent from Stephen Mirren, the newly confirmed Fed governor. He actually voted against the quarter-point cut. He wanted more, a half-point reduction.
That's a strong stance, and his reasoning is quite interesting, especially on things like tariffs.
Yeah, Mirren's thinking cuts against the grain a bit. On tariffs, he's definitely in the minority, saying they don't cause material inflation at the macro level. He sees them more as just shifting relative prices between goods, not driving overall inflation significantly.
And given he's a recent appointee, there's always that question of political influence hanging in the air. Did he address that?
He did, quite directly. He stated that President Trump called him yes, but only to congratulate him on his confirmation. He made it clear the call wasn't about his vote, wasn't about economic forecasts, essentially affirming his independence.
Okay. But here's the part that really jumped out from the sources, his take on border policy and inflation. That's unexpected.
It is, isn't it? He connects the dots in a very counterintuitive way. Mirren suggested that the administration's border policies could actually lead to disinflation, lower inflation.
How does that work?
His argument is that reducing net migration slows down the growth of the working-age population. Fewer people competing for resources, specifically housing, less pressure on shelter prices, which is a huge chunk of the official inflation measures like the CPI. So reduced migration equals potentially lower rent inflation.
It's a fascinating argument. That link between immigration, labor supply, and monetary policy, definitely something to watch. And then on the totally opposite end of the political influence spectrum, we had that wild suggestion from Steve Bannon.
Oh, right. Proposing Treasury Secretary Scott Bessent should run both Treasury and the Fed.
Yeah.
Which, the White House shot down almost immediately,
Yeah.
reaffirmed the traditional separation. But it certainly shows the kind of, let's say, unconventional thinking bubbling up in some circles about how to manage the economy, maybe speed up those rate cuts they want.
Okay, let's pivot from monetary policy to the markets themselves. The tech IPO scene, it definitely seems to be flickering back to life.
It is showing signs of life, yeah. We saw filings or buzz around Klarna, Gemini, Circle, Figma, big names. But resurgence might be too strong a word. The results we have seen are pretty mixed. It shows the market's still fragile. Look at Pattern, the Amazon reseller. They went public on NASDAQ, raised $300 million. Stock opened a bit weak, below the $14 IPO price, but then rallied to close up about 11% on the day.
But their CEO was quite blunt about their biggest risk.
He was, pointed straight at their dependence on Amazon. Something like 94% of their revenue comes through Amazon. That's a lot of eggs in one basket.
Wow.
And that kind of concentration risk or policy risk looks even starker when you compare Pattern to, say, StubHub's IPO. Not so great. The stock tumbled, 21% from its IPO price over just 3 days.
Ouch.
And remember, both Pattern and StubHub had initially delayed going public because of all the uncertainty around tariffs earlier. So the different outcomes really tell you. The IPO window might be cracked open, but investors are being very picky. They'll punish any perceived weakness or exposure really quickly.
And you can't talk tech without talking AI valuations. They seem to exist in a different universe altogether.
Feels like it sometimes. Sources were buzzing about Elon Musk's xAI trying to raise $10 billion at a, frankly, mind-boggling $200 billion valuation.
Though Musk pushed back on that number.
He did, called it fake news publicly. But even if that exact number is off, the scale fits the pattern, right? We just saw Anthropic valued at $183 billion, OpenAI potentially near $500 billion. It's astronomical. The sources said the money xAI is raising is mainly for building huge data centers and buying tons of hardware, GPUs from NVIDIA, AMD. Musk apparently wants 1 million AI chips.
1 million chips. Meanwhile, AI is creeping into more consumer stuff too. Meta's new smart glasses.
Yep, pushing AI further into everyday hardware. It's happening fast. But this brings us right back to those tariffs and what they mean for your costs right now. You mentioned policy risk hitting IPOs. Well, tariffs are hitting your electronics budget directly. Microsoft just raised the suggested price on several Xbox consoles here in the U.S. Again, second time this year, citing the macroeconomic environment.
Which often feels like code for tariffs and supply chain costs, right?
Pretty much. And it's not just Microsoft. So Nintendo, they've raised console prices too. It's a really clear line from import duties and supply chain issues straight to the price tag you see in the store.
Apple, though, seems to be trying to play it differently. Or at least say they are.
Right. Tim Cook came out and explicitly said the latest price bumps on some iPhone 17 Pro models up $100 are not because of tariffs. Their claim is they've worked hard to offset those costs, shifting production to India, Vietnam. Though they did admit taking an $800 million hit financially in the last quarter because of all the supply chain adjustments. So it's costing them somewhere.
Okay, so supply chains, online shopping, this leads us straight into something really crucial for consumers, trust, and some serious red flags this week about e-commerce safety.
Yeah, this might be the most directly concerning piece of news in the whole stack. A CNBC investigation dug into Walmart Marketplace. What they found was, in the rush to grow big fast, Walmart apparently let security standards slip badly. They uncovered dozens of third-party sellers who were straight up impersonating real, legitimate businesses.
Like actual known businesses. Give me an example.
Oh, yeah. We're talking fake online storefronts pretending to be, like Dimo's Pizza, a real place in Chicago, or LifeWorks ACS, an established professional service company. And these fake sellers were using Walmart's platform credibility to list dodgy products, especially health and beauty items, often heavily discounted, potentially dangerous counterfeits.
Counterfeit health products. That's scary. Things you put on your skin or ingest. They mentioned fake Nariva supplements.
Exactly. And sometimes marked down by like 91%.
91% off. Okay. That alone should be a giant flashing warning light for anyone shopping online.
It absolutely should. If a price, especially for supplements or cosmetics, looks ridiculously low on a big marketplace, your alarm bells need to ring loud. Assume it's risky. The investigation really showed the vetting process just wasn't catching these fakes, putting consumers at risk from who knows what's in those products. Now, Walmart says they've tightened things up since, especially for beauty and personal care sellers. But still, the buyer has to be vigilant.
So the takeaway for you, the listener, if you're buying these kinds of things online.
Check the seller, not just the product listing. Who are they really? Look closely at the packaging when it arrives, typos, weird logos, red flags, and treat those unbelievable discounts not as a lucky find, but as a potential sign you're looking at something fake, maybe even harmful.
Okay, definitely critical advice. Shifting gears to some, hopefully, less alarming news for the wallet. Gasoline prices.
Yes, finally some potential relief there. Gas prices are actually expected to drop this fall. Could it be down 10 to 30 cents nationally? Maybe getting close to $3 a gallon on average sometime in October?
What's driving that?
A few things lining up. OPEC Plus has increased oil production. We're switching over to the cheaper winter blend gasoline soon. That always helps. And maybe even the Fed rate cut plays a small role, potentially dampening overall demand a bit. The biggest drops are expected where prices spiked recently due to supply issues, think the West Coast and the Northeast. They should see the most relief.
Good news for drivers. And while we're on finances, what about Social Security? Any updates for folks planning retirement?
Yeah, we got some updated estimates for the 2026 Cost of Living Adjustment, the CALA. Right now, it's projected somewhere between 2.7 and 2.8%. For the average retiree, that means maybe an extra $54 to $56 a month in their benefit check. Also, important policy changes are kicking in. The full retirement age, or FRA, keeps ticking up. It hits 66 years and 10 months for people born in 1959. And then it finally settles at 67 for everyone born in 1960 or later. And one more thing. The maximum amount of earnings subject to Social Security tax is expected to go up too, probably to around $183,600.
Okay, good numbers to keep in mind. Let's wrap up by looking at that messy overlap between politics, media, and tech policy. Always volatile. What's happening with TikTok?
Well, the immediate ban seems to be off the table again. Reports suggest President Trump and China's Xi Jinping made some progress on a potential deal. Details are scarce, but it looks like they've extended the deadline, allowing TikTok to keep operating in the U.S. for now while talks continue. So that saga isn't over yet.
Still hanging out there.
Yeah.
And domestically, a new policy targeting tech hiring.
A big one. The Trump administration announced plans for a new, very steep application fee for H-1B visas. We're talking $100,000 per application.
$100,000?
Yep. The clear goal seems to be to make it prohibitively expensive for big tech companies. Amazon, Microsoft, Meta, the usual suspects to use the H-1B program. They rely heavily on it for specialized foreign talent. This fee is designed to drastically reduce that reliance. It's aggressive.
Wow. Okay. And then there was the whole media blow-up around Jimmy Kimmel's show.
Right. ABC suspended Jimmy Kimmel Live indefinitely after comments he made about the killing of Charlie Kirk. But that story quickly escalated into a fight over regulation and free speech. FCC Chairman Brendan Carr started making noise about potentially reviewing ABC's broadcast license because of the comments.
And that drew fire from, well, seemingly everywhere.
Pretty much. Bipartisan backlash. Michael Eisner, the former Disney CEO, accused Carr of out-of-control intimidation. And Republican Senator Ted Cruz went even further, comparing Carr's warnings to something out of Goodfellas, like a mafia boss threatening someone. Strong words.
It really highlights the pressure cooker media outlets are in right now, trying to navigate political commentary and potential regulatory threats.
Absolutely. And speaking of navigating tricky territory, there was also that update on President Trump's defamation lawsuit against the New York Times. A federal judge tossed out the $15 billion suit. But the reason was fascinating.
It wasn't about the facts of the case.
No, it was about the legal filing itself. The judge basically said the 85-page complaint was unprofessional, called it improper and impermissible, criticized it for being too focused on, quote, self-praise and lacking professional dignity. You don't hear that kind of critique from a judge every day. Trump's team has 28 days to try again, but they have to keep it under 40 pages this time.
Okay, so wrapping all this up, what's the big picture for you, the listener, as an investor, as a consumer? We clearly saw this wave of market optimism, especially in the U.S., thanks to the Fed cut, indexes hitting records, even small caps joining in.
Yeah, that market high definitely fueled more AI funding frenzy and maybe cracked open that IPO window just a bit. But, and it's a big but, the challenges right here at home are still very real, very acute. Policy whiplash tariffs hitting console prices one day, huge new visa fees aimed at tech the next that creates constant uncertainty. for businesses, for costs.
And maybe most directly, that warning about fake goods on major shopping sites, it means you as a buyer just have to be more skeptical, more careful than maybe you were even a few years ago. So we're living in this strange split reality, record highs in the market running alongside really intense choppiness in how things are governed and regulated.
Which leaves us with a final thought, maybe something for you to chew on. If the bedrock of market stability, of the prices you pay, seems so tangled up with political plays, whether it's appointees linking rate cuts to border policy or an FCC chair getting accused of intimidation tactics, how do you actually weigh the real risk in the economy right now? Can you fully trust these record market numbers when the ground underneath, the governance and regulation, feels increasingly shaky and unpredictable?